So we're going to continue where we started in the previous chapter on the topic of budget. This chapter, we're starting a new chapter, but the idea here is really continuing on what we started in chapter 22, understanding in more details how to do analysis on the differences between budgeted numbers and the actual outputs that we got at the end of the season. Okay, so this chapter we'll be learning what is flexible budget, which actually stands in the middle of what we did in last chapter, master budget. We will be doing flexible budget in this chapter and understanding why we're doing this to help us do analysis on the differences between actual and master budget. Okay, the second section will be introducing what is income statement performance report, and again is the variances between budget numbers and actual numbers. Then in more details, how do companies actually set standard costs, and what is the benefit of doing that? Standard cost basically is the budget unit cost. So we learned a lot about unit cost in the first three chapters. Remember, breaks down to direct materials, direct labor, manufacturing overhead. So at that time, these numbers were given to you, but we didn't really explain how to arrive at these numbers. So the middle section here in this chapter, we'll be going over how accountants and managers actually work together to determine these numbers. And then we will be using standard cost, that concept, to understand in more details flexible budget variances. So this chapter will be breaking down the differences between actual and budget variance into detailed sales volume variance, flexible budget variance, and then from the middle chapter and on, we'll be breaking down this part of the budget variance into more details. So basically all of these are doing detailed analysis on why are the numbers different from the budget numbers. Why are the actual numbers different from budgeted numbers? Okay, and at the end of the chapter and this Friday we'll be going over some of the transactions, how to record these variances. Okay, first of all, let's take a look at this comparison between actual results and static results. So in previous chapter we showed something very similar to this before introducing what master budget is all about. So here we pull this table out again and take a closer look at the differences in each and every category. So first of all, based on sales outputs, meaning the actual sales units and the expected sales units, is it that the actual output's better or worse than what we planned? Just based on looking at this table. Better because the actual DVDs that we sold out is 10,000 units. We budgeted as about 8,000 units. So we had 2,000 units more. And we put an F behind it means favorable. Okay, U means unfavorable. So anything that will boost up operating income, we consider it as favorable. So in this case, if we just look at units, the more sales we make, usually the more sales revenue we're able to get. Right? So 2,000 units we listed as favorable. And what about sales revenue? Because we have additional 2,000 units sold, so also, of course, our sales revenue usually will be incrementally higher than what we budgeted. So also we have a differences, $25,000 as favorable amount. Okay, now variable expenses, we see that we budgeted $64,000. Actual output is $86,000, which is not surprising because, remember, variable expenses increases along with sales increases, right? So we have additional sales, and therefore we have additional variable expenses. So this part here, the cost increased, we still listed as unfavorable, but really a lot of it is because we have additional sales, right? So contribution margin, remember, is the difference between sales and variable expense. We have additional contribution margin, $3,000, based on increased sales, so it's also favorable. What about fixed cost? It's actually also favorable because we budgeted $20,000 and the actual output was $19,000. So perhaps we rearranged some of the depreciation expenses or some of the labor rates, fixed expenses on employees' salary, we also rearranged it. The actual output was $19,000, the money that we spent. So this 1,000 is also favorable. So overall, these differences led to operating income. $16,000 is the actual output. We expect to have $12,000 actual output, the differences is favorable, $4,000. But knowing these number differences is not enough. We need to know why are there differences, meaning that we have 2,000 units more, but is that the same rate increase as what has been increased in variable expenses category? And why is there fixed expense differences? Right, so this chapter will be introducing flexible budget to really parse out why are there differences here, why do we have additional 4,000 operating income here. If it's solely because of sales volume variance, then these two would be the same. If it's not only because of $2,000 variance, we might have an additional, for example, if we expect that each and every unit incurs $8 variable expenses. And at the end, we realize that we only spend $7 variable expenses. So that $7, the difference is $1, is not because of that 2,000 units differences. Okay, so this chapter we really want to break down the variances into different portions and understand, is it only because of this 2,000 increase of sales units, or actually there's additional differences in variable expenses that you spend on selling each and every unit. Okay, so the purpose of introducing flexible budget here is to understand in more detail